Basic technical analysis principles are probably the biggest BS lie being told today.
What do hedge funds think of technical analysis?
Some of them love it and some of them hate it.
And it's being told to you by a bunch of people
Everybody else is looking at the same charts and the same fundamentals.
who are manipulating you into thinking you can just draw a bunch of squiggly little basic lines and start making money trading.
For me, in terms of my ability to make a decision, I prefer technical analysis.
The reality is the smart money is using a different strategy to actually make money. What you have to understand is that trading is nothing more than a wealth transfer from millions of people who are basic and don't understand what's going on, that deposit money on an account. All that's happening is that deposit is then ending up in the account of a small group of people that I call the wolves. There's about 98% failure rate in the market and only about 2% of people who collect all the money. So if you want to become part of that 2% who is collecting money, well, then I suggest that you hit the subscribe button, turn on the notification bell, and get out your notes, because I'm going to drop some dark truths about technical analysis and how this game is actually working. So first of all, what exactly is technical analysis? It's basically just the study of chart patterns. What you can do is go back and look at the history of all charts, all price action that's happening on any asset, and you can see exactly what happened in the past. And all you're trying to do with technical analysis is look for patterns that have consistently repeated themselves. And by identifying those patterns, if you see that same pattern forming up again, you can now create a game plan and a trade strategy based on the fact that you know that in the past, this similar situation played out in a certain way. Now you can anticipate what might happen again and hopefully make a little bit of money off it without losing too much. That, in a nutshell, is how technical analysis works and what its theory is. And these theories of technical analysis have been around for hundreds of years. And in fact, it started in the 17th century when the Dutch East India Company were the first people to start plotting the price of stocks on a chart. And that was the origination of looking at an actual stock chart. In the 18th century, this is when candlestick patterns were introduced by the Japanese rice traders, who were able to identify patterns just by looking at some candlesticks and understanding the open and close and high and low, which we now see every day on candlestick charts and basically every chart that you look at. And then in the late 18th century, Charles Dow created what is now known as the Dow Jones Industrial Average. All it was a compilation of stocks which enabled him to identify the macro trend of the actual market, which consisted of three trends. First was the primary, which was just the long-term trend that you could identify. Then the secondary, which was the pullback to the actual long-term trend. And then the minor trends, which was just a bunch of fluctuations in between. And then in the 1970s and 80s, we saw a bunch more patterns pop up, which you might be more familiar with today, such as the head and shoulders, ascending triangle breakout, double tops, double bottoms, and what have you. So what is the actual mechanism for why technical analysis appears to be working time and time again? Brief interruption here, guys. Did you know that 75% of traders have accounts under $25,000? This creates a huge problem because even if you double that account in a year, which is almost impossible, you're still only making $25,000. Introducing Hydra funding, where you can potentially get access up to $500,000 in capital. All you have to do, guys, is sign up for a challenge account, which is going to give you potentially access up to $500,000. And if you earn a 10% profit in this demo account without going into a 5% loss overall or a 4% loss in a day, you will then pass their evaluation phase and yes, get access to an account with the selected size account. And now, instead of trying to double a $10,000 account, you could potentially earn only 10% on a $100,000 account to earn the same level of profits. And the benefits of this are huge. Rather than risking your entire $10,000 on one account, you can use just $1,000 to potentially get access to $100,000 in capital. You can trade crypto, Forex, stocks, CFTs, gold, oil, everything under the sun, all on MT4 and MT5. If you're interested, if you have an account under $25,000, like 75% of traders out there, you're not going to make any money with that account because it's too small. Get access to pro level funding and pro level capital with Hydra funding. Link's going to be below. Well, it all comes down to what is known as the self-fulfilling prophecy, where we begin with a belief and our belief creates an expectation. Our expectations influence our actions or our behavior, and our actions and behavior influence the actual result or outcome based off of our actual behavior. So let's just take a look at the Bitcoin chart and see how the self-fulfilling prophecy based on technical analysis theory actually works out. So we have the beliefs, expectations, behavior, and results. And in this example, based off of technical analysis, the belief is that there is resistance at 19,621 plus or minus. Okay, now that creates an expectation that if price breaks out and pushes back up into that level, that there is going to be an area of what is called resistance. That means that there's going to be less buying pressure at that area. It's going to be increased selling pressure. There's also going to be a bunch of people who are taking profits in that area, or people who are going to begin to short sell in that area in expectation that price will come back down off of that level. So our expectations of that influences our behavior, which will create a bunch of selling pressure at that level. The result could be that we actually see a pullback off that level. So let's just take a look at the chart and see what happens. As price pushed up into that level, you can see the expectations initially created a big sell-off, right? So the expectation was there's going to be an increase in selling pressure and reduced buying pressure, which would create a pullback. And you can see that there was a 16.5% pullback immediately after we tapped right into that level. Now, we then began to form up another pattern, which is a flag breakout pattern to the upside. This basically resets the cycle of the self-fulfilling prophecy. The belief is that this pattern is a breakout pattern, which is bullish, which could lead to increased buying pressure if that level of about 19.6 to 19.7 breaks out to the upside. So if it does break out to the upside, that is going to create the behavior of a bunch more people buying in that level, as well as people who were short are now going to get stopped out, which then increases the buying frenzy that happens. If we can look and go into the future and see what happens, we can see as soon as that actually broke out to the upside, that creates the expectation and behavior of higher prices to come, which creates the actual human behavior and action of people buying and buying and buying. And you can see the result as this thing just went on a monumental run all the way up to 42K from there. So that's all technical analysis is. It's a self-fulfilling prophecy playing out time and time again based off of the patterns that we have identified to repeat themselves over and over again based off of the technical analysis theory. The next thing we need to discuss are breakouts and breakdowns, which are for the most part also a lie and a way to manipulate you into believing that an all-time high breakout could lead to you becoming extremely wealthy. Well, if prices are down and suppressed for a while and you see a breakout to the upside and you're in the beginning of super cycle bull market, maybe that happens. But for the most part, this is the exit liquidity zone where big and smart money is actually making you believe that it's time to buy when they're actually manipulating you to buy so that they have someone to sell to. This was actually introduced by someone in the late 1800s to early 1900s known as Richard Wyckoff, who created the Wyckoff method. And he created something that was called the composite man. And this is a quote off the internet that says, "The composite man attracts the public to buy a stock in which he has already accumulated a sizable line of shares. By making many transactions involving large numbers of shares, in effect, advertising his stock by creating an appearance of broad market or a market as a whole." Basically influencing people to think that this is the next big thing, this thing is blowing up, you should potentially buy as well. And then as soon as prices break out, all that is a big chunk of buy volume for that composite man or smart money to exit out of that position. Okay, and we can see the actual schematic of the Wyckoff method here. That final breakout to the upside, all that is liquidity and a manipulation of telling people that this is the time to buy. This is when you see Bitcoin breaking out at all-time highs, headlines everywhere, everyone on the news talking about Bitcoin on all-time highs, breaking out, here we go, everyone at the dinner table, should we buy Bitcoin? And then next thing you know, that turns into a reversal or a trap that I call, and then everything comes crashing down, and everyone who bought at the top now just lost all their money, and the composite man or smart money use them as exit liquidity to lock in their gains as they had already been accumulating in a prior period. If we look at the actual Bitcoin chart here, this exact scenario playing out, everybody thought that we were breaking out above 64K to go on all-time highs, and everybody was saying that we're going to 100K, CNBC, all your favorite crypto guru influencers. Everyone is telling you that now is the time to buy and we're going to all-time highs and going to 100K. Whereas me, myself, someone who has had a little bit more experience, 20 years in this game, I did not look at that as a buying opportunity, rather a selling opportunity. You can see me tweet on November 16, 2021. I said that's what we call a trend reversal on Ethereum and a bull trap on Bitcoin. This is the actual chart that I was looking at the time. And if you also look at the Wyckoff method, this is a pretty similar pattern to that final exit liquidity zone before we see a big reversal. And if we look at actually what happened in the markets, that claimed the top of the bull market in late 2021 in November, and then we saw a push to the downside. You can also look at this on the other side for looking at a bottom. You can see the similar schematic, but in reverse of this actually breaking down to the downside, faking everyone out, and as soon as that broke out to the upside, that claimed the bottom of the market. Now, it's obviously easier said than done to actually identify these things. While I did identify this as the top of the bull market, I did not identify this as the bottom of the bear market. I was expecting a little bit more and coming back all the way down to 10K. So I'm also human and I also make mistakes. And that's also why technical analysis or trading is as difficult in general, because we don't know actually what's going to happen in the future. We can only make an educated guess based off the things that we see to potentially try to protect ourselves going forward. Now, speaking of breakouts and breakdowns, you can make a shitload of money buying breakouts in a super cycle, such as this breakout that began down here at about $12,000 on Bitcoin. This is when I turned 20K into $1.7 million as the markets just absolutely ripped to the upside for the next 1.5 years. Then when I called this trap or Wyckoff end of the cycle exit liquidity zone here, I made $500,000 going short and long during the bear market. The most important thing that you have to understand when looking at technical analysis is the market moves in different cycles. And if you're using a strategy in a bull market, you can't use that same bull market strategy when the market shifts to a bear market. The problem is most people use one strategy, they're a one-trick pony, and they can only make money in a certain type of market. All bull markets come to an end, and typically, especially in crypto, you see 80 to 90% drawdowns after the bull market ends, and it usually wipes out everyone with them. So the most important thing that you need to do when it comes to trading is understand that this is a game of psychological manipulation. If you're thinking like everyone else, if you're watching the news to get your trading advice, you're not going to be making money, because those are the people who are trying to manipulate you, or basically working for the composite man, who are trying to use you as exit liquidity. So the goal is, don't become exit liquidity. Think differently. Think of this as a psychological game in trading, okay? And you're not just going to draw some basic squiggly lines. You have to understand that you need to take advantage of people that aren't in the know. You need to take their money. All trading is a transference of wealth from dumb people to smart people. So try to become smart, try to make some more money, and try not to become exit liquidity. I talk more about this in my brand new book called The Wolf Principles, which is basically just a getting started guide. It's not a full-blown strategy to make money in the markets, but what it is a foundation for understanding the framework of how people are actually making money in this game long term. There's no get rich quick strategies that are going to be talked about in this book, because get rich quick strategies don't fucking exist, guys. Okay. So anyways, that's a wrap for today's video. Like, comment, subscribe, and I will see you in the next one.